What does a Trump victory mean for equities markets, bond yields, and portfolio allocation? We'll be talking about this with Peter Boockvar, CIO of Bleakley Financial. Welcome back, Peter. Good to see you
Thanks,
again.
David. Good to see you as well.
You've been on the show a couple of times earlier in the year. You were correct in calling for the long end of the curve to rise. So congrats on that call. We'll be getting your outlook on bond yields today, as well as the equities markets. Take a listen to this particular clip from the FOMC meeting this week.
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talked to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong. And you're seeing, 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers.
So strong economy, labor market really isn't even a concern for them anymore, and they're performing better than their global peers in the G7, I guess. So Peter, let's evaluate what he said first. Do you agree?
Well, then that begs the question, why did they cut interest rates? So the Fed Beige Book of a few weeks ago, which is what basically the question was referring to, out of 12 districts, 10 saw no growth and 2 saw modest growth. So when Jay Powell says that it's a strong economy, headline-wise, GDP-wise, yes, it is. But I think under the hood, there's a two-lane economic highway. You have the fast lane that's being driven by anything related to AI capital spending. The upper income consumer is still spending pretty healthily with the help of the wealth effect of higher stock prices, home prices obviously being much higher and being less sensitive to the cost of living increases. But and then you also have anything related to government spending, healthcare via Medicare, Medicaid, and anything related to infrastructure, the CHIPS Act or the IRA beneficiaries. And then on the other side, the slow lane is the lower to middle income consumer, manufacturing that's in a recession, trade that's flatlining, and the existing home market that has seen the slowest pace of sales in 30 years. So it is this very weird, strange, as I said, two-lane economy. And to just throw a broad brush, say the economy is great or it's not great, or policy is restrictive, which he said, well, it's restrictive for some, but it's certainly not restrictive for the financial markets. I think it's a really confusing story, but the Fed is making it seem like there's this clear path to rate cuts and everything is going to be fine, and they'll make up some neutral rate, I guess, when they find it.
You mentioned manufacturing slowing down, industrial recession, perhaps. Do you think Trump's policies can turn that around by Q1 2025?
No chance it happens that quickly. I think manufacturing is going to recover when inventories start to get rebuilt again, when end demand picks up. Now, can that happen? I guess so, but that would happen with or without him. My worry is if we know we're going to get tariffs, and we have to remember in 2018, manufacturing went into a recession in response to the tariffs. So I worry that, in fact, maybe manufacturing gets worse depending on how these tariffs play out. Is it very pinpointed in terms of what they're trying to do here, or is it just going to be all over the place? If it's all over the place, obviously that's a problem. If it's very pinpointed, I think we can manage that. But those details are to come. And looks like Robert Lighthizer, who was the architect of the 2017-2018 tariffs, he's going to be the architect of the next ones to come.
It's all about managing expectations as well. Like you said, we don't know if it's going to be pinpointed tariffs are all over the place, but I am reading stories online of small businesses or manufacturing businesses buying raw goods and inventory now for the next year because they're expecting perhaps input costs to go up because of tariffs. So, are you concerned about the prospect of a huge surge in demand from businesses now and then just slowing down next year because they've already stockpiled?
Yeah, that's definitely something we're watching out for. Is any pull forward related to that? And you can maybe even see it in the numbers. What we saw this week was China export numbers for October jumped much more than expected, and you have to wonder if that's a pull forward of business activity and stocking the shelves ahead of these potential tariffs. So we might have already begun that process.
Peter, what are you most concerned about? We'll talk about the risks first and the opportunity. What are you most concerned about in regards to the markets under a Trump presidency?
What I'm most worried about, and it would have been the same worry if Harris won, is the bond market, and not just the U.S. bond market, but the global bond market, because we're seeing, an epic unwind or I should say, an unwind of an epic bubble in bonds, and I do think that the higher for longer mantra, which we've heard so many times over the past couple of years, is a real thing. And that while the Fed will continue to cut short term interest rates, I think longer term interest rates across the yield curve are going to stay higher. And I do not discount the possibility that the 10-year retests the 5% level that we saw last year. And whether that's because of continued worries about U.S. debts and deficits, whether that is a tariff battle that mucks up business activity that leads to higher inflation, or it's the BOJ raising interest rates again, or it's the ECB losing control of their yield curve, whatever. That to me is the biggest risk here. The thing with the stock market is most of the market's actually trading reasonably valued, not certainly not cheap, but it's the big names that are very expensive. And when you look at the S&P in the aggregate, trading at 24 times 2024 and 22 times 2025, that's something that worries me as well. Now, valuations don't matter until they do, and it hasn't been worth it to pay attention to valuations for a while. Because if I'm right with interest rates, though, I do think that there's going to be greater sensitivity to those levels of multiples. So that's the thing that I'm keeping my eye on. And also, there's still a lot of wood to chop when it comes to digesting this higher cost of capital world. If you're a small, medium-sized business, you're paying 10% on a loan on average. And there's a lot of debt that matures in the coming years where the rates that are going to be newly priced are going to be well above the loans that were priced pre-2022 that are maturing.
Speaking of the 10-year yield, yes, you have been correct in calling for higher yields. We're not at 5% yet, but since you were on the show earlier in the summer, the 10-year yield has been rising. This is the 10-year, and if you overlay this with the 10-year break-even inflation rate, you'll see a very close correlation here. Could you maybe explain the rise of the 10-year with rising expectations of higher inflation going forward, and perhaps coupled with higher economic growth? Is that the reason for the rise in the 10-year?
Well, yeah, I mean, it's certainly the bottom in the 10-year was, I think, the day of or the day before the Fed cut 50 basis points.
Yeah.
And it's clear that Jay Powell, in his press conference this week, did not take heed at the market reaction at all, because he was rather dismissive when someone asked him, what is about this rise in long rates after you cut interest rates? So that was actually a concern of mine, that he really didn't pay much heed to this market move, which tells me that they're going to head themselves into another mistake if you don't listen to the markets. And it's not just the 10-year Treasury he should be listening to. It's the price of gold as well that he should be listening to, because that's sending its own message. But if you want to sort of pinpoint why we've seen this rise, it was, yes, I think it was cutting 50. And if you're an owner in the long end of the curve, you don't want to see the Fed getting complacent when it comes to inflation. Now we've had some mixed jobs data since. We had a great jobs number for September, and a pretty weak one in October. Obviously, the hurricanes had an influence on the October one. The core CPI number that we saw right after the Fed meeting was a little bit hotter than expected. And as you say, we've seen this rise in inflation expectations. And also, I think that the issues with debts and deficits mattering. I think they matter now. And for 40 years, they haven't mattered. I say 40 because 40 years ago, people started to get concerned about debts and deficits. And
Yeah.
one of the reasons why, well, two of the reasons why I say it matters now is I'll get back to the price of gold. To me, that's a sign that it matters. And number two, look at the gilt market this past couple of weeks when the Chancellor of the Exchequer, Rachel Reeves, came out with the new UK budget for the new Starmer government, and the market had a hissy fit. So that was another sign of, at least in the Western sovereign bond world, that investors are beginning to pay more attention to debts and deficits. Look at the French 10-year yield, which has ticked up because people are wondering what the new budget is going to be there. So I think these all combine for the rise in yields, and you can't just say I'm going to analyze U.S. growth rates and my prediction about inflation, and this is where I think the 10-year yield is going to go. I think it's got to be a deeper analysis, and the laws of supply and demand may actually, for the first time, be coming into play here in terms of longer term yields.
So it's not normal though, right? From my understanding, it's not normal that right after a Fed cut that we have the long end of the curve go up. That doesn't usually happen, does it?
Well, we have to keep in mind we saw a big drop in rates going into this meeting. So just for perspective, the 10-year yield at around 430 is exactly the 50% retracement from the 5% on the upside to the 360 on the downside. So to
Yeah.
be fair, all we're doing was we're taking back some, but that still is I believe, like sort of a slap in the face of Jay Powell, which he obviously didn't, as we said, didn't realize at the press conference that the market sort of pushed back against what he did. But to your point, does it happen? I mean, sometimes it has where the 10-year yield would creep up because if the market interpreted the Fed as getting ready to stimulate, then
Hmm.
that would be future inflation and growth and don't want to own the long end. So there is some of
Yeah.
that. But I think the rapidity of this rise in rates is noteworthy. And another thing, to this is that the day before the Fed September meeting, the December 2025 Fed funds futures contract was yielding about 280 to 285. So they
Sure.
were expecting an aggressive rate hiking cycle through the end of next year. Now that 285 is actually about 380. So the market has taken back about 100 basis points of priced in rate cuts post that meeting. So a lot of what Powell tried to do, has sort of backfired. And that's why I actually thought he should have done nothing at the November meeting. Not because maybe the labor market needs another cut or parts of the economy do, particularly, like I said, small businesses or commercial real estate, whatever. I just thought that the data has been so confusing. You have a brand new president who is not so brand new and could come with either faster economic growth or tariffs or whatever. Wouldn't it have been prudent just to say, you know what, we got another meeting in 6 weeks. Let's just digest what we're going to hear, what we're going to see in the data, and then we can always cut again, especially after you cut 50 in September. So I think because of that, I think the Fed is really relying more on their models, and they have this sort of real rate in mind that they want to get to, and they're just on this. They're back to this one track mind of we need to get to this real rate without paying attention to that the world has changed since that September rate cut, and that's why I think that long rates are going to continue in fits and starts. That long rates will continue higher, and that
Yeah.
that'll be the real test for the stock market whether it can maintain these earnings multiples. Because most of the rally this year in stocks has been multiple expansion more so than earnings growth.
Well, that leads me to my next point. So the relationship between the stock market and the 10-year yield has been fickle. It's not always correlated. It's not always inversely correlated. Over the past year, year to date, there have been periods when they've moved together. That has happened, of course, throughout this rise in the 10-year since September. Do you expect this relationship to hold? Meaning, if you expect the 10-year to rise to 5%, can the stock markets follow?
I don't think so. Now, what level it sort of triggers the worry, I'm not sure. But I think that's a level of pretty good competition when it comes to the stock market, particularly when the S&P 500 has a dividend yield of about 1%. That's a pretty stark comparison buying, a T-bill or some duration compared to the S&P 500 dividend yield of about 1%.
Yes.
So that's just something that investors should keep in mind.
Well, what's the risk for
You
the
do as
stock
well.
market right now? What's the risk here?
Well, the risk is the multiple again, because earnings growth has been running um, below the pace of PE multiple expansion. So if you just get a little multiple compression because of the rate move,
Mm.
irrespective of what the economic policies are going to be, that could be a risk. And the tariff situation is going to be a risk. And but on the flip side, easing of regulatory pressures, I think, is going to be very positive. Uh, M&A bankers are partying it up this week, post Tuesday night, because of Lena Khan probably leaving the FTC. The financials are certainly going to celebrate easing of financial pressures. The energy sector likely will as well. Now, with the tax side, at best, taxes probably stay the same. So I see the reduction of a negative rather than an incremental positive. So I think that the market is very exuberant here on Trump, and I understand that relative to Biden, but I just think that the real incremental benefit is going to be more on the regulatory side, less on the tax side. And so I think that they're just probably getting a little ahead of their skis here.
If Okay, so would monetary policy be a risk in the sense that if, let's say, the market's pricing in um, 100 basis points of cuts next year, let's say, I think that's what it's pricing in currently. But let's suppose that the markets are also pricing higher inflation, and the market's right. Inflation stays above 2%, and the Fed doesn't cut as much as initially anticipated. Would that be a bearish trigger for the stock markets?
I think that it could be. Uh, the stock market loves rate cuts. It
Yeah.
loves the easy Fed. And I'm not saying that because I think it. I'm saying it because we have plenty of evidence over many decades. So anything that gets the Fed to cut less, I think that would be, perceived negatively when you have a market that's trading, as we said, a multiple where it
Yeah.
is. This is
I,
one of the
I,
more
I,
expensive stock markets we've had ever.
You're absolutely right. I bring this up because it was a weird dynamic this year. We called that in 2023, late last year, the stock market was, well, the bond market was pricing in what, six, seven rate cuts. That didn't happen in 2024. Uh, we had a disappointment there, yet the stock markets continued to grind higher. Why do you think stock markets continue to be bullish despite the disappointment in the lack of rate cuts this year?
Well, up until July, and I'll define that moment in a second,
Sure.
AI, the whole AI trade gave the market a second wind
Yeah.
in early 2023. That's clear. And, it got to the point at the July highs that the top 10 stocks in the S&P 500 were 37% of that index.
Yes.
Compare that to March 2000 when the top 10 stocks were 27% of that index. So Google, Meta, Microsoft, Apple, that whole trade, Nvidia, it didn't care about the Fed. It was all AI. So that's what really performed for the market. Now, in July, we started to get second quarter earnings that where the market started to sort of differentiate the whole AI trade. They started to question all this capital spending and so on. So it started to more scrutinize the spenders of all this money relative to the beneficiaries like Nvidia and other infrastructure names. And then in the third quarter, I think that analysis continued. But the positive on that is that the market decided to broaden out,
Mhm.
and buying other things has been able to keep the market going. And then certain names like Amazon and Nvidia have gotten sort of second legs here.
Let's flip over back to the Trump presidency. Which assets are you most bullish on? In other words, the Trump trade. What is the Trump trade for you?
There really isn't any. To me, we might have already had it the Wednesday after the election. When you look at the financial stocks, when you see JP Morgan up 10% in one day, I mean, it's not an internet stock. It's not a meme stock. Or when I say internet stock, meaning going back to the
Sure. Yeah.
1990s, I'm aging myself. So you maybe pulled forward the Trump trade. So I haven't changed my portfolios. We haven't here as a firm. We're going to appreciate taxes not going up and the regulatory easing out there. But the sustainability of this market bounce or in response to his election, I'm not sure. But we have our thesis on things, and I don't necessarily think Trump is going to change that. But we would certainly welcome a healthy economic environment. I'm just worried about how the bond market's going to respond to that.
Well, the stock markets think that Tesla will benefit from a Trump presidency. That's what happened the day after. Looking back, it's still not anywhere near its all-time highs, but that's a different story. Any specific types of companies we think would benefit from a Trump presidency? I mean, Elon Musk companies would kind of make sense. Is there growth potential here beyond this jump?
Well, at the end of the day, Tesla still has to sell cars, and Trump is not going to get people to buy more cars. The demand's going to be the demand. So, like when Trump was president, energy stocks did poorly. You thought they would have done well. When Biden was president, energy stocks did great. You thought they would do poorly. So we're focused on trading the policies rather than the politics. And big picture, like I said, the policies are going to come down to taxes and regulations. And the tax side at best is likely going to stay the same. Government spending will continue on as is. That's another concern for the bond market. And in the regulatory side, considering the moves in these financial stocks, they 10% move in a day, that may have already again pulled forward some of the benefits there. So I'm not sure necessarily how to trade the regulatory side of this. But if the economy can stay on firm stead, if China can put a floor under their economy, if the global economy can start to grow in a quicker pace, maybe commodity prices rise, which we're weighted towards that. I particularly like energy. I think oil prices at $70 is a great buy. I think natural gas prices. So we're long stocks in that sector. I was bullish before the election on gold and silver, and I remain bullish post-election on gold and silver.
Even at gold at current levels?
Yeah, central banks are not going to stop buying gold because Trump won. And if anything, maybe they buy more because he won. So I think a lot of the big picture themes for us and myself and the portfolios I manage are not going to change with him being elected, just as they didn't really change when Biden won.
Trump tax cuts, how significant would they be on earnings expansion?
Probably not much because, like I said, at best, they stay the same. Trump had the benefit in 2016 of a lot of low-hanging tax fruit. He was able to cut the corporate income tax rate from 35 to 21, which I think was very important to do because the U.S. industry, corporate America, needs to be very competitive with the rest of the world. But at best, it's going to probably stay at 21%. I'm all for individual tax cuts across everyone who pays income taxes, but at best, all they do is get extended at current rates. So there's no incremental benefit on the tax side here, is what I think people should understand, as opposed to 2016 when we got this big benefit from lower rates.
Let's talk about gold for just a minute because you're bullish on gold. So I'm going to flip over to my chart one more time. This is the US dollar. This is the DXY. And immediately after the Trump victory, we see it spike up. And in the same time, we see gold go down commensurate with the rise in the DXY. Makes sense. But the markets liked the dollar. The markets did not like gold. I have a few reasons why, but I'll let you answer first as to why that move in particular happened the morning
Well,
of.
Well, the dollar rally, I can point to, well, we had a rise in interest rates, so that helped the
Sure.
dollar. But
Yeah.
also, if we're gonna, in theory, tariffs are supposed to lower your trade deficit as you then import less and hopefully you export more.
Hmm.
So lowering your trade deficit is usually currency bullish. So I think it's those two factors for why the dollar rallied. And gold to me was just a knee-jerk reaction to that strong dollar and jump in interest rates on top of what was an overbought gold position anyway.
How much of this is pricing in the gold drop? How much of this is pricing in perhaps a reduction in the geopolitical risk premium? Keep in mind, Trump has said on the campaign trail that one of his priorities on day one is to end the Ukraine war. He also wants to end the war in the Middle East, right? He gave Netanyahu a deadline of by the time he enters office, end the Gaza war. That's what he said earlier in the summer. So I don't know if that's going to happen, but that's what he said. Perhaps gold is factoring in fewer wars. What do you think?
I never thought that gold was a geopolitical risk play. Um,
Okay.
Now, the benefit that gold got from geopolitics was not the war itself, but it was the US and it was an economic war. It was the US and EU freezing half of Russia's central bank reserves, which then freaked out a lot of holders of US treasuries and US assets and got them to start buying more gold.
Hmm.
That doesn't change upon a Trump presidency. Xi Jinping is not going to say, okay, the Ukrainian war is over. I'm now going to buy less gold. And Putin is not going to say, okay, I'm going to buy less gold. And certainly the Saudis are not going to buy less gold. So I don't think that trade ends, even if those wars end, because I don't think buying gold for geopolitical reasons is a long lasting strategy.
Okay. And the last asset I want to bring to your attention is oil, crude oil. Didn't really react positively to the Trump victory. In fact, it was just kind of like hovering range bound here. Any policies that may or may not affect the energy markets that you're looking out for, Peter?
Well, with respect to Trump, from a regulatory standpoint, he's obviously going to be more friendly. I think the benefit from that is really going to be on the sort of the LNG side and export side, where Biden stopped all new permitting, which was a stupid thing to do, and I think that goes away rather quickly in the new administration. In terms of drilling, uh, companies on private land are drilling anyway. Uh,
Hmm.
Now, if can Trump open up some of the public lands? Yeah, for sure. But the price still has to be right. An oil company is not going to drill if the price for the product is not right, irrespective of what permits are handed out.
So long term, then, given your macroeconomic outlook, are you neutral, bullish, or bearish on energy?
We're very bullish and long.
Okay. Okay. Anything you're not bullish on in respect to the Trump presidency over the next 4 years? In other words, what would stay away from given a new president?
Our investment decisions, I don't care if Mickey Mouse was president.
Right.
Uh, it's we're not saying we need to sell this because he is president. I think that the names that have the potential of underperforming are those big cap tech stocks because they're so big right now. I mean, Nvidia $3 trillion. It's not going to six. It's maybe the numbers are so big, and I do think that we are going to see in the next year or two a major deceleration in capex AI spend, and as everyone digests all the current spend, and then we're gonna test out is whether all this spend was worth it in terms of the economic return. And so I think that these big cap tech names, in terms of their outperformance relative to everything else, I think that there are going to be other parts of the market that are going to take the outperformance baton, so to speak.
Okay. Great. Well, your overall tactical, first of all, if Mickey Mouse for president, I think we should launch Disney, but that scenario is never going to
We're
happen.
long Disney.
You're launch Disney. What is then your overall tactical strategy, irrespective of politics?
I am also very bullish on Asian markets. The next 10 years, to me, the most exciting economic growth story, and I've said this many times, is the growing middle class in Asia. And regardless of who's president here. I mean, you have the world's population, and whether it's per capita incomes rising in even in Japan, I'm sorry, not Japan, China, Indonesia, India, Thailand, Vietnam, Philippines, Malaysia. To me, these are all very exciting economic growth stories, and we're trying to find companies that can tap into those consumers.
Good. Well, thank you very much. Where can we learn more from you and Bleakley Financial Group?
So you can go to our website, bleakley.com, and I have my own Substack page. And people are interested, they can read my daily missives on the macro markets and other things.
Great. We'll put the links in the description down below. Thanks very much, Peter. Look forward to catching up again. Take care.
Thank you, David. You too.
And thank you for watching. Don't forget to like and subscribe.